What's going on, everyone? In today's video, I'm bringing you the latest updates in Southwest Florida's housing market for November 11th, 2021, including two major stories affecting future buyers and housing affordability around the country. That's coming up right now. Welcome back, everyone. I'm Rick Harrison with MVP Realty, and on this channel, I teach you everything you need to know about living, buying, and selling in Fort Myers, Florida. So if you're considering moving, visiting, or just looking for something to do in one of the Gulf Coast's favorite cities, this is the channel for you. So make sure to subscribe and click the bell to get notified every week when a new video drops. And don't forget to leave a comment below. I love reading them all, good, bad, or indifferent. Today, we're taking a look at this week's market changes in Southwest Florida and what the details tell us about the future of our housing market. All right, so let's dive on in. So today we're going to be starting out with the inventory and market analysis. I'm going to be comparing the last 7 days to last week's market analysis. We're also going to be talking about the interest rates and the updates on it. And then we have two major housing market stories that will affect the future of home buying and affordability for most homeowners and future buyers. So let's get right into the stats. So last week, left-hand side, and this week on the right-hand side, the arrows in the middle indicating the kind of the indicators as far as what's going on in the market. So as you can see over on the right-hand side, new listings are down 3%, only down a handful, just a little under 13 uh, listings difference. Solds are down 11%, which is almost 100. It's actually 97 um, homes less this week sold. And then extended. So this is something we haven't really talked about too much, but an extension is when a contract ends. So a seller has a contract for 6 months with a listing agent, and after the 6 months, it still hasn't sold. An extension is basically adding time to that contract. So if you take a look at the left-hand side, there was 119 last week extensions, and this week there's only 56. So it's down 53%, which means less homeowners are willing to extend their contracts. I would just assume that this goes to the thought process of, if we already had our house listed on the market for in this really hot market and it didn't sell for what we were looking for, then why am I going to extend it now, as seeing that the market has started to level off, a decent amount. And then we also have the pendings down 7%. But the key number here is the extensions. Less homeowners are willing to put their home back on the market this week. We'll have to keep a close eye on this number to see how it fares over the next several weeks. Just because one week, isn't really a great indicator, but it could be the start of a trend. Also, interest rates. This is updated as of today. On the right-hand side, the interest rates, according to Nerd Wallet, which is based on Zillow data, is down to 2.9%, which would be down a full basis point. 4 points. And then bank rate at the bottom has their average 3.3 last week. Now it's down to 3.2, which is consistent with down 4 points overall. So that goes in the wake of the Federal Reserve announcing that it will begin tapering their bond purchases. We're going to discuss that later. But with the bond purchases being tapered, they also did say that they were planning to hold off as long as they could at increasing interest rates in the foreseeable future. They're hoping to not have to do any of that until either late into 2020 or possibly even late into 2022, or possibly holding off as late as 2023. So we'll see what happens with that coming up. But the housing market news and trends. So two huge articles that I read over the last week or so. The first one is Ivy Zellman. If you're not familiar with her, she was one of the housing analysts who called in 2005 that there was something going on with the housing market, and she called the housing bubble 2 years beforehand. She has now emerged saying that there's some more red flags, or at least cautionary flags coming up, that is putting her on edge and a little bit nervous about what's going to happen with the home market. And we're going to talk about what she says is going on and what is actually driving prices versus what we've been all hearing, which is the housing deficit. The inventory is so low. She says that that's not it. So we're going to take a look at what she's got to say about that. And then also the Federal Reserve to taper bond purchases I just mentioned. So we're going to take a look at what that means and what it could, mean for the possible future of interest rates and housing affordability. We'll see if the Federal Reserve is still considering inflation transitory, as they've said. And we'll also take a look at when will interest rates rise potentially. So Ivy Zellman, housing deficit mirage. This was a article in Bloomberg. You can take a look at the link in the description to be brought right to that article. You can read it yourself. But just to kind of summarize it, everything in red is really the most important parts of it. So Ivy's saying that she's pretty concerned about the market right now. She feels like it's at peak levels or near peak levels. She hasn't been this concerned since the housing bubble. And even though nothing, she's not saying that it's going to crash or that it will crash for sure, but more so that in the next year or two, she thinks there's going to be some type of correction. And currently, she sees a storm brewing with a lot of the stuff that's been going on and been in the news lately. And we'll talk about a few of those. The pace and price of growth, this is nothing new to anybody who's been watching me, but if this is the first time tuning in, the pace of price growth has slowed down quite a bit. We went over the charts of October, and over the last month and a half, you can see that the chart is starting to become a little stagnant as far as it's not increasing and it's not decreasing as far as demand or supply. It's just kind of sitting and stuff starting to stay on the market longer. Bidding wars are suddenly giving way to discounts in places like Boise, Idaho, and Salt Lake City. And then also a modest rise in the 30-year mortgage, which we've actually seen this week. It went down a little bit, but even she feels as even if the interest rate was to rise up to just 4%. Now, keep in mind, we've seen, in decades before this, there have been interest rates at 11% up to 18% interest rates on mortgages. Now, we're going from 3%, but she feels even if we go up to just 4%, it brings demand to a halt because we're seeing the market is already at sky high prices, the homes. So it's already unaffordable for a good number of people. Just simply increasing that rate 1% would make it completely unaffordable for a good majority of people who have been waiting and holding off. So the big question on everybody's mind is, well, so if that's how she feels about this, if she thinks that there really isn't a housing deficit and there's a mirage, what's going on with it? Well, she's saying that investors are driving up prices beyond the reach of primary buyers, and builders are also bidding up land values because everybody's made a rush to real estate. Everybody knows that this is the hottest thing right now. Great place to make money. So investors rush. And instead of, homeowners, the primary buyers being able to buy these houses for what they were hoping to, investors have been scooping them up, creating this kind of false housing deficit or inventory deficit. And that's causing prices to just go up, and buyers are just getting tired of it right now. At the same time, builders, who either weren't builders beforehand and got into it just because of the market, or have been seeing the trends and the prices of real estate going up so much, have been scooping up as much property as they can to really try to capitalize on it and build these houses with a huge profit margins for a lot of these builders. So what's driving it? Obviously, the risk is, and what she's worried about is that investors, after buying up all these places, and especially like iBuyers and even private equity firms, which anybody who's been following the housing market news knows that Zillow last week had to reduce its workforce by 25%, laying off 25% of its workforce, and also completely scrapped its iBuyer program, which was basically an algorithm or computer program that told Zillow employees when to buy houses and for how much, overestimating and overbidding houses by as much as $65,000 in some markets. So that, coupled with the fact that they've already seen the market leveling off, this is exactly what she's worried about. They're getting spooked and starting to sell these properties, which Zillow is going to do. From what I've heard, they're going to be selling over 7,000 properties and taking $150 million loss to sell it to BlackRock, and a private equity firm. So what they'll do with the supply, we're not really sure of. They could hold on to it and lease out the properties for as an investment, or they could bring the supply to the market and sell it off. But either way, BlackRock is making out on that, getting the purchases at a fraction of what Zillow was paying for them. So overall, Zillow is taking a huge hit on that, which is one of the things that Zellman's worried about. Because when they do get spooked and they start selling like they will, they're going to overload the market with supply, which in a market that's being propped up by investors and builders and not actually the home buyers, is going to produce more supply than there is demand, which is going to drastically drop housing prices. So if you're a buyer who's been waiting, this article by Zellman's good news for you. It just means that in the future there may be a huge decrease in home prices. And the bad news on that is that these home buyers and investors who are going to be caught holding the bag potentially, may have to take losses, and have more supply than they have demand, which could cost them a good amount of money. So the second story, the second big story, and this is going to be more to do with inflation and affordability of houses, is the Federal Reserve announced early in November, just last week, that they were going to begin tapering the bond purchases. What I'm interested most is the amount of money that they've been spending on bond purchases just to keep the interest rates low and the economy going. Um, their current spending is $120 billion a month that they're purchasing in bonds. Now, considering that we have a double-digit trillion-dollar debt to in the entire economy, $120 billion doesn't seem like too much, but that's just every month. So the process that they're going to be going through is a reduction of 15 billion each month, 10 billion in treasuries and 5 billion in mortgage-backed securities from the current 120. This is a source from CNBC in an article. And what that's, I mean, in a market that's already highly inflated, the big thing is that people are worried about is, one, um, just on the left hand side, price increases have been more rapid and enduring. So central bankers forecasted that it was going to take longer, and it wasn't going to be as rapid as it has, but it hasn't. So what does that mean for us? Well, the reduction in bond purchases will conclude around July 22nd, 2022. So that's when they're thinking that the reduction, by reducing 15 million every month, by July 2022, they will have been able to taper off completely. And that is when we will start to see the rate hikes beginning, after it's finished. So they're only expecting next year in 2022 one increase at the most coming next year. But again, that's, nobody can predict the future. That's their hopes. And they also did say that, you know, one they one they've obviously got the forecast wrong, which we just saw in the last quote. But two, they already said that they're going to make adjustments as they need to this. So if they feel like they can increase more, then they will. If they don't, they may back off. But it's really up in the air at this point. And then obviously inflation, it's at a 30-year high right now, and that's just been multiplied by the supply chain issues that we've been having due to the pandemic shutting down most of the country. Also, the high consumer demands for these goods that we went without, or these services and things that we used to do, that we didn't do during the pandemic. Everybody's rushing to do that, especially down here in Southwest Florida. We have a lot of foreigners in Canada and overseas, who couldn't come here last year because of the travel bans. We're going to be seeing a flood of that, demand coming back and we're already seeing it in Collier and Lee counties, with the tourist and how tourist market. So the on top of that, now we also have the rising wages because the labor shortage that's going on. People are having to work more, and work harder hours than originally, so they're starting to ask for higher wages. So you couple all that together, and obviously the Federal Reserve is saying that they're acknowledging that inflation is still transitory, but they're using it a little bit. They're backing off of it a little bit, and they're saying that this could take a little bit longer. So my sources that I use for this: CNBC, Bloomberg, they both had the articles on Zellman and the Federal Reserve tapering, and then NerdWall and Bankrate I used for the mortgage rates, and they update those every week. And then the data for Southwest Florida comes from the Southwest Florida MLS. So that's it for this week's housing market update. But if you still have some questions, leave me a comment or shoot me an email at rick@swflrelocationteam.com. Well, that's it, folks. I hope this information was helpful and you learned something from it. And if you did, please hit that thumbs up button and let me know what your thoughts are on Zellman's theory in the comments. I love hearing from you all and reading what you have to say. And don't forget to subscribe and click that bell for more info just like this every week. Thanks so much for watching, and I'll see you next time.